let's take a look at oil. Now, this has been my sweetheart for a time. Prices tend to come in the spring, and it's because we don't use energy in the spring because we open up the windows.
Right.
So this has a lull. On top of that, it is a leveraged ETF. I can't remember if it's double or triple. It's
triple.
Some kind of crazy. And so look at this. I don't know if it's because of a repricing event or whatever, but the low in December of 2022, $1,730. Yeah, a little bit bananas. So what I'm expecting this chart to do is come in and test frontline support and break to the north again. Look, we made a rounded bottom. It took, about a year. Let me see.
And I misspoke here, Anne-Marie. This is a double. Okay. This is a double levered ETF, not triple.
No problem. All right. So here we have this rounded bottom. And if we take a look at something like this and we say, maybe this might be a cup and handle before summertime breaks in, all the nat gas stuff goes crazy. And then we've got something else going on. Okay. So I easily suspect a retest of 120. So the question is, how do you trade this since the options are so expensive? So I do covered calls at the money, right? And so I'll buy the stock outright and I'll go 2 months forward and I'll sell the covered calls. And it's because the premium has been bananas. I also sell the puts. So a couple of things that you can do. If you say to yourself, this might be pretty good, right? You could go into May when things start to heat up a little bit. And you can say, you know what? Let's see where everybody's sitting. Oh my word. Look at that. That spread is more than $2 wide.
Yeah, that's crazy. It's double the bid. It's more than double.
Bananas. Okay. So the average price is about $61 right now. So you could sell those, but it doesn't look very good. Here's the beautiful thing about this. If you put these orders in at the mark, they will force them to fill. I've never had one not fill at the mark or better.
Interesting.
So here we are in May, and we're looking at this 80 event, very thin, but again, they will fill. So somebody's doing something here to force price action through. So if you look at the 80 to the 90 to the 100, $2, so $200, $1,000 upside. If you are so inclined, you can also sell a put spread that is right at the floor near, you can say 70 to 65. And those, that's more than half of the spread. It's the options in here are the implied volatility is so high that trading inside of here is just absolutely fantastic if you're selling the option. So you can sell a put spread. You can also you can turn it into an iron condor. Where did I go? May. And since things won't be getting too crazy, you might go up here and say, you know what? I'm going to sell the 105 110s. You get almost half of the entire spread.
Wow.
And so here's a way you can look at it. So the big thing is, Anne-Marie, you know what it means when an option has high implied volatility. the prices could swing all over the place. What do? You look to take 20 to 30% of the spread and you get out of Dodge.
Okay.
Yeah.
And if you can scale out, better still, probably. If you're taking multiple of these, that's good.
Exactly.